Thank you, everybody who has joined us today. We are very lucky to be joined again by Phil Michals, CEO of Alliance Global Partners, and Chris Davis, Vice President at Federated Hermes. For those of you who may remember, these gentlemen both joined us back in March when the market was in pure chaos. So it's pretty amazing in almost 5 months to see what a difference that time has made. So really today, I think what our objective is to take a deep breath and maybe provide all of you with some perspective of where we are. Obviously, we've come a long way in 5 months, but there's still a lot that needs to happen. So, Phil and Chris, I don't know who wants to start. Why don't you just give us a general overview of where you feel like we are right now and what we can maybe expect as we move forward?
Like Mike said, I think last time we were all in this call was March, and I think Chris, myself, and Mike, and the team the theme of that call was, now is not the time to panic, and that generally markets come out of these downturns quickly and in several days as opposed to a long, it's not necessarily going to happen in, month after month after month, but majority of it happens in short periods of time, so you make back most of your gains. And we were down probably the S&P 25 to 30% then, and we said, hey, I remember leaving the call saying if you could, not look at your statements over the next couple months, you're probably doing yourself a favor because we feel that the market's going to come back. And then I think Chris also went into historically how markets rebounded during the downturn. So I think, history proved us right. We're probably up 25, 30% from the S&P then. We also touched on it being a healthcare crisis back then. That's what the economy was really working off of then. If anyone replays it, they'd see that we felt that the mortality rate was going to be much lower than it was. It was, people were thinking 4 or 5% and, 2%, 3%. And our view was it would be 0.5% to 1%. Obviously, any percentage is too much, but that the mortality rate would be lower, treatments would be coming out, and we'd be getting clarity. So I think in some of the big theme points, I think we ended up being proven right. Now, it's not to say if you look at today's market, everything's come back. And you keep hearing, people on TV saying, well, there's a disconnect between Main Street and Wall Street, right? There's a disconnect of what's happening locally. And that's true in certain industries, and it's not true in others. I mean, if you're a holder of the bank stocks, you're down more than the S&P. If you're a holder of the hospitality industry, you're down, still more than the S&P. If you're a holder of the REITs, right, you're down in the MLPs. You're still down more than the S&P. So not all of the markets come back, but generally you should be in better shape. But there are pockets of this marketplace that haven't come back yet. And, now the question is, where are we going, right? So the market, our thought was the market was generally going to come back. We talked about back then the PPP hadn't been approved yet, but if you go replay it, our view is it would be approved in a short time frame because both parties needed to get that done. And now we're kind of in a similar situation politically, right? They're talking about a new stimulus because the PPP is running out. So if you say, where are we going? I think you have a little bit of a different dynamic, and I think it's a little less certain because we've had that 25 to 30% run up. So we know a couple of things. We know that conventional wisdom says we will get a vaccine, either by the end of the year or Q1, right? So that's going to be a catalyst for the market on the plus side. It'll probably be more than one vaccine. There'll probably be multiple vaccines. It's going to take then 3, 4, 5 months, 6 months to get enough people vaccinated to get a herd immunity going, right? So we know it's going to be rough sledding for a lot of the restaurants, some of the hospitalities. the theme parks, right? It's still going to be some treacherous going for the next 3 to 9 months. But again, Wall Street looks forward, right? So once that vaccine happens, you're going to see probably those theme parks, the airline, the hospitalities move up. And at the same time, you may see your technology companies such as Zoom and your Amazons, maybe take a breather. We have that the new government stimulus isn't as sure this time around. We've seen them do small extensions on it. And I think that's a combination of the market rebounding, and we have a November election, right? So that's going to be kind of the unknowns of what's going on. And I think what we got to look out for is, in the election, there is a little bit of an unknown. The market's probably priced in probably a 60-40 chance that Biden is going to win the election. It hasn't priced in, though, the Democrats winning the Senate. So if Biden wins the presidency and the Democrats take the Senate and conventional wisdom says they're going to hold the House, you can see a market pull back on that. Not to be political, but generally the markets like a divided government. And I think if you have a Democratic-controlled House, Senate, and presidency, you're going to have more regulations and higher corporate tax rates, which just generally are going to affect the public markets out there. So that's one thing to look out for as a red herring out there. I think, we're going to obviously have a little bit of clarity over these next 90 days on the election, on the PPP, and the vaccine. So it'll be an interesting time. I think it's a time not to necessarily make any material moves in the marketplace, but it's, I think we should be prepared for a choppy market. So that's my general thought process of where we were, where we are, and where we're going to be.
I would add for full agreement that I'm grateful that you invited us in to try and help make sense of this during the absolute peak of madness. I mean, we all chatted a few months ago, and we were just trying to make sense of the healthcare crisis and what's going to happen tomorrow. But one thing we didn't know is that this too shall pass. Markets will not be looking to what's happening today, but rather where we're going to be in a year. And so one of these with price falls, you have just as sharp a reaction back upwards, and we have seen a historic rise in stock prices. And some people can ask, how can that possibly be when COVID is still very much a thing, and when the economy is, we still have over 20 million people unemployed? Well, because they're stocking in what companies are going to make next year. They're not thinking about what businesses are doing today, and they're actually fairly pricing in companies that are making less money. To Phil's point, there are companies out there that are going to die during this period. There are always companies that will struggle and die because they were not going to be successful long term. I mean, think about the difference between an Amazon versus a JCPenney. Old world company that wasn't able to adapt to the current environment. But there are just as many. There are far less companies that will die than those that will double. Because what this has done is it's accelerated the opportunity for companies that are nimble and can meet the changing needs of customers and clients throughout the country. So from a market perspective, it's actually acted very rationally. It's rewarded most of those companies that are benefiting from this shift we've seen. And it's been a little more, and it's lagged behind in rewarding those companies where greater uncertainty lie. So when we think about the market, we have to remember that the market is not something you invest in. It's just a collection of 500 very different companies. And right now, about 80% of those companies are hardly being rewarded. Most, in quote, the market has been just the largest companies that make up the biggest part of that. The S&P 500, for example, is not 500 invested in companies, but actually the top 10%, top 10 companies, I should say, represent a quarter of the market in terms of access, in terms of the exposure. So just a few companies have driven markets now back to all-time highs as of yesterday. We have literally never been higher than this in terms of the broad market. But the opportunity to invest in businesses that have lagged behind because they have yet to see a clear path out remains. So it feels as though markets have run really far, really fast, maybe too far, and there's always a potential for, as Phil mentioned, maybe it's a political outcome that causes the excuse for a pullback. Long-term, businesses are worth what they make. Businesses are simply companies providing goods and services to human beings. And right now, people are in more need of goods and services and a little bit of fun and a little bit of positivity than ever before. And that's why we can see an environment where while we are still dealing with a crisis, we can also see companies making sense of that, providing the goods and services necessary and being rewarded by higher share prices. So just to echo that, and then I'll turn it back over. I'm sure we'll have some questions. I don't want to offer too much up too early, depending on which direction you guys want to go.
One question that we're getting a lot, obviously investors seem to have what I call FOMO, fear of missing out, now that this market has come rallying back the way it has. Where would you guys put money to work? Studies have shown timing the market is typically a fool's game, but would you agree that there's still pockets in this market that make sense to invest in?
So, I do think if you do view that there is a vaccine that's going to come out, and you view that that's going to happen in relatively the next 3 to 6 months, then I think you do have to look at the Disneys of the world, SeaWorlds of the world, the JP Morgans, the Goldman Sachs, and the banks. Some of the sectors that have not enjoyed as much of the run-up, right? A lot of the REITs that have been really depressed. You got to be careful, obviously, because there's a reason they're trading there. But if you do believe that we are going to get ahead of ourselves in the next 3 to 6 months on these issues, I think there are sectors that you can find value. Other than that, I think the idea of continuing, as Mike, I think you're right, it's very hard to time the market, right? 10 days out of the year give you most of the market gains. Other than doing your averaging in as you normally do, I think there are certain sectors you can look at with your customers and the clients and find value.
Phil, I know you've mentioned the vaccine. Can you shed some light on what the sentiment is near you in New York there? Are you guys kind of operating at like 80% productivity? Can you just shed some light on what the scene is like by you?
So on the vaccine front, I think there are two questions. On the vaccine front, it seems like, whether it's Novavax, Moderna, those seem to be getting the most publicity on the vaccine front. Now, it could end up being a Regeneron it could be a Johnson & Johnson, it could be a Merck, but kind of the upstarts of the Moderna and the Novavax. Novavax went from single digits to trading north of $100 per share, and over $1 billion government grant. So I think there is a view that we're going to get something out there by the end of the year. New York City itself, the question is, we have very low cases. July was probably the highest case count across the U.S. And as of now, the U.S., I just read this morning, we're at 36% less new cases than we had at the height in July. So across the U.S., cases are lower. New York, the cases have been lower, but that's a factor of the whole city being basically shut down. So I don't know if it's, that we're saying, hey, look, we're doing such a great job in New York City, but New York City really has not really been active. It's pretty much been a shutdown city. So we're about a 10 to 15% occupancy. I think there are going to be some systemic changes because of this. You are going to see people work home more than ever did. So I think part of our workforce is going to come back because they like the idea of the socialization, the creativeness of being next to an employee. but I do believe part of the employees are going to be working from home. So I think commercial real estate is taking a hit. Individual apartments for people to stay in New York City are taking a big hit. There's a huge inventory right now on apartments in New York City, so I see that taking a hit. I can see simple things like you don't think about. You know, the high-end clothes for men, for example, whether it's, your Armani's or your Hugo Bosses. When this comes back, there's going to be less formal dress attire in the workplace in certain industries. So I do think we'll see some systemic areas that will change. People are going to more Zoom meetings. Even when the economy comes back, we've realized that we could probably save money by doing things like we're doing right now, as opposed to face-to-face. So travel is going to be a little bit less. Catering events is going to be less. Our holiday parties, right? Normally right now we would be booking our holiday parties at a lot of the different facilities out there, and it doesn't look like we're going to do that. So I do think there are some changes that'll be long-term. Short-term, though, there's definitely going to be, at least locally in the New York City area, it's going to be a tough year for, especially come September, October, November, when we can't do this outdoor seating in the hospitality industry. It's going to be, I hear, the stats that about 25% of the restaurants in the city aren't going to make it through. So hopefully that's not the case, but we'll see.
And just to follow up quickly, is the sentiment that basically activity and occupancy isn't going to start to significantly increase until there is a vaccine?
Absolutely.
Okay.
Yeah, but I can actually add a bit to that if that's all right, just to jump in. So, yeah, vaccines are coming. Phase 3 trials have begun with a couple of companies. Pfizer is partnered with BioNTech, and of course we have Moderna, who's pretty far along their RNA vaccine as well. I mean, really the most promising, but the problem is just having enough of it. So remember that, once you get a vaccine approved, then you got to make enough of it. Most of these companies are actually producing at risk. They're already producing the vaccine before they've even gotten it approved, so that they hopefully have enough to share it. But then the next question is, where do you distribute it? Let's say we get 10 million units available, from the first approved one on day one, and call it November would be optimistic. Maybe it's November, maybe it's December. Well, then how do you distribute that fairly? Who gets it first? How do you do that? All those questions are still being worked through right now. So it's not as simple as vaccine arrives, problem is gone. There's a matter of distribution, production, and also obviously a matter of people just feeling comfortable taking a vaccine that was rushed through. So, we're probably a long way away from the healthcare crisis being cured. At the same time, if we can manage to continue to operate in this unique way, where we are able to still life somewhat as normal and adapt and continue doing our jobs and living a pretty darn good life, we can limp along long enough to get through this, such that the vaccine helps and it just keeps us moving. The only risk from coronavirus at this point is a renewed and heightened shutdown, where we do go back to literally, forcing to remain open again. That would be a concern. And while we have a lot of hope in the treatment of the illness, we also have to recognize the balanced reality of just having enough vaccine and getting it distributed is a very real next step.
Another question I want to bring up, because this will be I'm losing count, either my fourth election in the business, but I think, you're going to start getting a lot of people asking, what does the election mean for my portfolio? And obviously, you hear this all the time, but people say, is this time different? Obviously with the media and how heated things are right now, it's easy to get caught up in the moment. But how do you both feel that the election could possibly impact the markets in the coming months?
Awesome. Phil, if you don't mind, I'll start. I think you shared some wonderful comments before, and I'll go off of those. So first thing is, always encourage people to be passionate about their politics, be passionate about their investments, but not to convolute. Over time, markets don't move based on politics. Markets move based on economic cycles. So when you talk about how the market is done under one government regime versus another, while there's a relationship, that relationship is often misguided, because the relationship really is, if the economy is growing well and inflation is low and everything's pretty healthy, stocks tend to go up. And that sometimes has a Democrat as president. That sometimes has a Republican as president. Now, Phil made an awesome point that the market generally likes divided government because there's more certainty of the lack of change. And companies try and build their projections over the next 5-10 years. And if you're making business decisions, you prefer to think things are that the playing field in which you are running your business will not change. So fundamentally, we believe the market has, if you look at polls, certainly Biden is leading Trump significantly. If you look at the components of that, generally speaking, the approval rating based on economy are about split. That's why you hear him continue to campaign based on how great the economy is and how he's going to have to make it great again, and so on. He's playing that angle, hoping that people are thrilled by how quickly we've returned to the stock market and the economic standpoint. Where his approval rating really languishes is in his handling of the COVID crisis and the George Floyd related issues. That's where nationally he has less approval. So it'd be interesting to see which one of those ends up being more important. We have a recession that actually tracks the probability of a president getting reelected, and right now it's genuinely a split. It's a dead heat because there are some factors, economic factors, that are in Trump's favor. There are some factors that are not. It's pretty hard to call. One thing we can see is we're pretty likely to see more fluctuation as the possibility for larger policy changes increases. Again, echoing Phil's comments and reinforcing them, the Senate may be the most important race this year. Who wins presidency has probably less to do with this than the Senate race, because right now you have 53 Republicans, 47 Democrats in the Senate. So the Republicans do have a majority. If you see 4 seats flip, or the presidency plus 3 flip to Democrats of those seats that are up for grabs, you would then have a full Democratic, and it's very unlikely the House changes. You would have actually what has been the most common arrangement of government over the last 200 years. Most commonly, more times than any other, we see a Democratic president, Senate, and House. In fact, 40 of the last 116 years have been all Democratic. What we have never seen, ever in history, is a Democratic president, Democratic House, Republican Senate. So just based on what has been seen, we literally have never seen an environment where if Biden wins the presidency, the Senate remains in Republican control. Could happen. It seems pretty unlikely given the spillover effects of goodwill if Biden is in fact elected. The reason, and we again, with Kamala Harris being a little bit more moderate than some of the other choices, I think the market is a little more comfortable with that ticket of Biden versus Kamala. The real question, though, is, does tax reform get enacted in a meaningful way? The thing that affects companies near term is expectations for their earnings. Earnings is just how much they make after expenses and taxes. Well, guess what? If taxes go up, it has an immediate negative impact on the amount of money a company makes. And that's a potential catalyst for a revaluation or a price fall in those stocks. And since the prices have not fallen in those stocks just yet, it's unlikely that that's priced in. So that does not mean, however, because it is unknowable who is going to win that presidential election and Senate election, it is not a good idea to invest based on that, but rather to acknowledge those risks and find ways to diversify them. In that environment, bonds will likely hold up pretty well. In the companies that have lagged the most behind will be the ones people do not gain from, because another proposed change in this election that's on Biden's tax plan, taxing the dividends from stocks, to begin taxing them at a normal income rate versus current preferred rate. Well, imagine that for a second. That maybe actually cause people to take profits from companies and lock in gains so that they can pay a lower tax rate. So there may be knock-on effects in term that could affect some businesses more than others. Likewise, if you think that your tax rate is going to go up, you might want to lock in some of the huge gains you have in Facebook, Amazon, Apple, Google, Microsoft, which have led this market, and pay a lower tax rate this year than paying a higher tax rate maybe next year. So it is hard to call. Those are all possibilities, and if it happens, we'll be able to say in hindsight that it happened. The thing I want to drive home again, though, is over time, companies are worth what they make. As long as you have good people running great businesses to serve the needs of the people, both in terms of goods and services, the companies will follow their profitability, not politics.
I mean, listen, I think I covered it a little bit. I think Chris did a good job there. I would be a little, I think, short term if the Democrats do take the Senate. I just think it's, if we're going to have higher corporate tax rates, which is basically what they're saying, and we're going to have more regulation, you just got to ask yourself, is that good for business? My view is if if we're going to increase the tax rates, you're going to have lower earnings, and if you increase those regulations, you're going to have higher expenses. That is going to have an effect. Now, I agree with Chris that over time, I think it works itself out, and you can make arguments that the stock market does better under Democrats, and then you can have Republicans say, well, that was because the Republican administration set up the policies that they're taking advantage of. And you could have that debate back and forth and make a good argument on either party being a better shepherd. But I think, we have prior to the corporate tax rate being reduced, we had one of the highest corporate tax rates in the world. And the issue is, if businesses are transportable, are they going to stay in the U.S.? So to really make it simple, New York City has having an issue. 1% of the top earners in New York City are paying 50% of the taxes. And you have Governor Cuomo trying to bring those two we have a Democratic governor and a Democratic mayor in New York City. So you have two Democrats on really both sides of the issue. You have Mayor de Blasio saying we need to raise taxes to take care of this budget issue. And you have Governor Cuomo saying if you raise taxes on the most portable people in the world, right, because these are people with discretionary money, they're going to leave the city. And right now they've left the city and they're not paying the city taxes. They're in the Hamptons, they're in Connecticut, they're in Florida. So New York's problem is that people are moving out. People are moving to Florida, the biggest increase they've seen in the state. People are moving to Texas. People are moving to Puerto Rico. So when you make a material increase in the tax rate on companies, you're going to see potentially the same thing. If they think it's long-term effect, and if it's material enough, if they say, you know what, we have to look at a more competitive way of doing business. So I would keep my eyes on the Senate. If that, and I think I learned something new on this call, because if you had asked me the question, has there ever been a time where, that Senate, the stat that Chris gave, where Chris, you said it's never happened, right?
It has never happened where we have had a Democratic president and House, but a Republican Senate.
Right.
Yeah.
So,
we have also incidentally never had a Republican president and a Republican House with a Democratic Senate.
right.
So it's interesting how divided government is hard to work out. The Senate usually is the thing to watch.
So that makes it more interesting, and probably, if you want to bet on history, may not necessarily stay in the Republican hands. But we'll take a look on it, and that's what makes it interesting. I wouldn't do any large changes to the portfolio. I think it would be very hard to get in the taxing of transactions, right, which the Democrats have talked about in the marketplace, where they would tax your trading. That would be something that's kind of floated around on the Bernie Sanders, Elizabeth Warren side of the party place. I think if that got traction, that would be something that, we'd have to really think about the consequences on. But at this stage, it doesn't look like that has enough support within the party to get through. But it'll be an interesting time through November.
Yeah, isn't it amazing, Phil, how taxes are incentives, and wherever you put a tax, people will go to the path of least resistance. Giant city tax in New York, you go to Florida where there's none, and so on. And I think that's true of anything. So if you just think broadly about the only real relationship between politics and business long term is how does it change the incentives of the playing field? Is there a cheaper place I can run my business just as effectively, just as easily? And interestingly, a countervailing or a counter effect of this whole thing is right now the tariffs, which are just a tax on outside the United States, has created an incentive for companies to no longer do business in China or overseas as much. Beyond that, it's not just tariffs. Actually, it's the real tax of, no weird diseases come from Kentucky, except for maybe alcoholism. But China, if you have your factory in China, you have to deal with rampant diseases like this. You have a government that can, on a whim, decide whether they want you to succeed or not. Right now, there's a fundamental incentive for companies to come back and take advantage of the country that has the cheapest available natural gas in the world, such that you can run a factory today with robots that can't get sick and never quit and are able to run an effective business regardless. So we're seeing, as long as the tax rate is fair in the United States and competitive outside, there are a lot of incentives for business owners to bring their business back to the United States. Now, the Biden plan says 28% on the tax, which, by the way, is actually just the weighted average around the world. So if you look at all developed nations, the proposed corporate tax rate is higher than it is today. It'd go up 3%, but that's still significantly lower than it was 2 years ago. So that is a net still probably okay. Near-term impact, not terrifying. We'll see, though. As you said, no, we've probably beaten this one up pretty good, but hopefully we had fun doing it.
Well, and this is great, guys. I do have one question that I want to make sure we get answered before you have to hop off, Chris, because a couple of people have asked now, where do clients find income? There's been a lot of dividend cuts or dividend suspensions in a lot of sectors. We're dealing with what appears to be record low interest rates. For people who need income, where is the best place to go without sticking your neck out too much for risk?
Wow, so you just said the whole thing. Where can I get free, safe, yield abundance? Get a time machine and go back to 1980. The truth is, it's a very fair question. Globally, where around the world free, safe yield is no available. Every government has used purchase programs and excessive stimulus to essentially drop the yield or the income received on government bonds, the safest source of income, to zero around the world. In fact, there's a record level of trillion with a T, which, Phil, I can't even visualize what a trillion is. They say you stack up $100 tall, and that's $1 billion. You fill a football stadium, and it's $1 billion. So we're talking like dozens of football stadiums full of $100 bills. It's a lot of money. But $15 trillion in negative yielding bonds. We talked about that on the last call, that it doesn't make much sense. It's really a way to punish people for not taking risks. So the governments are essentially telling you, if you want free return, it doesn't exist. So what that does is it forces us to think differently about what risk really is. Long term, the risk is you run out of money. Near term is that your money fluctuates. There's no way to get good yield from something, so good income from something that won't fluctuate today. That's been taken off the table. If you want fluctuation-free income, you don't get that. But you can get a very solid income stream at the most attractive prices we've seen in 50 years from businesses that sell Tylenol, toilet paper, toothpaste, that you pay for your cell phone bill, that just deliver your packages from Amazon, UPS is a business. If you look around the world, income bonds with fixed income have paltry income. They will predominantly give you a safe but low return, or safer but low return. The best place to look for income today is absolutely by owning shares of businesses. Now, you mentioned dividend cuts. This is where I mentioned the phrase double or die. Which businesses you own today matters more than ever. The difference between winners and losers going forward will be wider than we've seen for a long time. You can no longer just buy every company which pays a dividend and won't be able to afford to pay because they didn't adapt fast enough. So it's very important to be selective in the businesses you choose to own and make sure two things are true. Businesses care about maintaining their income and that they have the ability to do so. So they want to and they can. So the broad market, if you just look at the all dividend-paying companies, and remember, dividend is just paid to shareholders. It's a cash income stream paid from stocks. Of all the companies that pay a dividend in the S&P 500 of the broad market, about 17% have had to cut their dividend this year in the United States. Something more like 40% had to cut their dividends outside the United States, because outside the United States, many governments actually required banks and others to suspend their dividends. So it has been the challenge for collecting income from stocks we've ever seen. What that has done is those stocks as attractive as they have ever been from both an income and a price appreciation standpoint. So I'd be looking to own a select group, a focused group of companies that do the things we use every day, that are priced as though they're going out of business, even though they're running a robust and good, healthy business, and collect those income streams. Do it in a diversified way. You know, obviously we have that. There's great, boring businesses doing the things we use every day. There has never been a better time to access that. And just to give you a sense of yield, because I get excited about it. So right now, if you go and buy the riskiest bonds out there, so bonds that have a lot of debt, high yield bonds, the income you're going to get there is about 5.5%, 6%. If you're going to, and that's fully taxable, so you got to pay your full tax rate on that income. If you're going to go and get income from high quality, AA single rated companies that provide basic needs going out of business anytime soon, you can get 5, 6, 7%, and you don't pay full tax on it. So you got a double whammy. Not only are you getting the same income from stocks as you would from bonds, you're getting 10 times more income from stocks than you would from government bonds, but you also have some tax advantages that we hope stick around. Even if you didn't, it's never been more attractive to own businesses for income.
So there's a couple of different routes I can go here because you touched on quite a bit there. So thank you for that. Let's start with kind of where we were at our last call from a fundamental and a market standpoint and where we are now, because it's pretty much been flipped. And I know, Chris, you had talked about typically the stock market does lead the economy, and that certainly held true here, where fundamentals were fine, but prices started to tank on expectations. And now we've seen the opposite, where prices have recovered, but fundamentals haven't followed suit yet. So what I have seen happen, and I'm hoping that maybe you can touch on this, but what this pandemic has really done in this recovery is widen the trend that we've seen over the last few years, where growth companies are performing noticeably better than value companies. And a lot of those dividend-paying stocks that you're referring to would tend to fall in that value category. So can you shed some light on where you're seeing, or Federated Hermes is seeing, the opportunities in value, or are they still leaning more towards growth type of companies? Can you shed some light on what that breakdown is, or where you're seeing opportunity?
There's no such thing as a value company or a growth company. Those are just indices arbitrarily created by a company called Morningstar about 30 years ago to try and understand different types of businesses and allow people to understand a little more granular level rather than just asking how is quote a market doing, asking more about specific parts of the market. The problem with that is there's no such thing as a value company, which generally is cheap, nor is there any such thing as a growth company, which generally just means expensive and more innovative. But what there are companies that I describe very simply as there are companies that require a growing economy to make money. Typically value companies, which Phil actually expressed these as industries. So if you think about banks, materials, industrials, energy, companies that rely on a robust economic growth period to make money, those tend to be more tend to struggle when the economy is shut down by the federal government. So if you're in an environment, and those companies tend to be a better representative. There's a lot more of those companies in the quote value index, economically sensitive companies. Those as languished in this time period because you expect the economy to slow down rapidly. You want to go for the other side, and that's the defensive, non-cyclical, the companies that make their money regardless of what happens. Think about Salesforce.com. They, a software for us all to stay and understand our clients and all that. The last thing that a company is going to suspend is their contract with Salesforce.com. Essentially now, many technology companies are basically a utility. We are not going to change our behaviors. We're not going to stop paying our cell phone bill. We're not going to start buying phones. That's the last thing we're going to stop doing. And therefore, the growth index, which has a lot of technology, care, consumer products companies that are for our lives, those companies aren't hurt as much by economic swings because they make money kind of regardless of what happens in the economy. Well, when you're in a country like this where you have no certainty around the economy, investors have rewarded near term those companies they feel can generate money regardless. Now, where it all changes is as soon as that economy picks up and gets rip-roaring, then people say, well, if all companies are going to stay in business going forward, I want the cheap ones. That is why actually we at Federated Hermes recently polled the wins that we've had. Because undeniably, there has never been a period in the last 50 years, including the tech bubble in 1999, 2000, there's actually smaller disparity between those non-cyclical growth tech healthcare companies and the economically sensitive cyclical value companies. We've never seen a difference this wide. And so we recognize both that unique nature of difference as well as we believe the economy is picking up. And so good money is going to be made on the value side. Now, that's why we pulled a little bit out to balance, which is always good to go. Hey, if you make a ton of money in something, you don't make money by buying high and selling low. You make money by selling high and buying low. Undeniably, the thing that you're selling high right now is growth tech, especially the top 5 stocks in the index. They've just gone bonkers. And the thing that you're buying low is cash flow dividends and cyclical businesses that require a robust economy to grow. All 3 of them will make you great money over. All 3 of them belong in a portfolio at all times. But by far and away, the cheap stuff are those cyclical companies and the dividend payers.
Great answers. I want to make sure before we hop off here, if there's anyone out there that have other questions, please feel free to enter it into the chat box. While we wait for any lingering questions, is there any advice you guys would have for people heading into year end? It's hard to believe that we're already talking about that, but
yeah, wow.
Any big picture ideas you guys have to leave people with?
I'll go completely off market here. I think whether you've been directly affected on a healthcare side of this crisis, whether you've had family members who've been ill, whether you've had effects on your business, the way you do business, the relationships, this has been a tough year for everyone. I mean, there are plenty of things to worry about. And I imagine most folks on the phone have had moments, I certainly have, and have them regularly, of just despair at a difficult year that 2020 has been in many ways. And the one thing that I found to try and that is just an attitude of gratitude is to genuinely, consciously think every morning as I'm having a cup of coffee on my back patio looking out at the woods, which, find those moments, whatever your moment may be, but consciously focus on that are great in my life, the things that the people that I can be grateful for. I mean, gosh, if you live in Minnesota, Wisconsin, you can't be happy with the weather this year. I mean, geez, something. Well, I guess by definition, if you live in Minnesota and Wisconsin, as we do, you're never happy with the weather. But but I'd express that there is so little about the environment we can control aside from the way that we process our own personal health and wellness. Do your best to express gratitude. Do your best to be specific about that, and know that this country and this planet is just a whole bunch of people trying to live the best life for them and their family and their community. And that therefore, while it seems like all people can feel like they're getting pulled into an argument anytime they talk about whether it's politics, racial justice, even in the markets, and it needs to be or rather than us working together. I can assure you that that's not the actual case. Most people just want to do well by others, live a good life, and make a difference in their family and community. That hasn't changed. Let's maintain that hope and know that over time, it does, if the world were going to come to an end, it would only happen once, and it never has yet. So I think we can be confident that this too shall pass.
I would just add, on the portfolio side, I would stay the course. I do think we're going to have some volatility with the election and with the vaccine. But I wouldn't necessarily move to cash or make any major changes, assuming that your portfolios have recovered well into this marketplace. Going back to what Chris had said before, looking at the value companies, that's obviously you want to always review with Mike and Jake and the whole team that you're in the right companies in the right sectors and you're balanced. And I would look to what are going to be the lasting effects of what's happened. And there will be lasting effects. I mean, we've accelerated a virtual economy at a much quicker pace than if this COVID didn't happen. There's a whole new sector that the online businesses had written off that they would never go online because of their age that have now gone online. So there was an age group of 60 to 80 that hadn't purchased anything online or used anything online. All the modeling said those people now will never go online because they hadn't. And the point is, if they hadn't by now, they never will. There's a higher percentage now that have been forced to go online that actually learned it and said, you know what, I know how to do this, whether it's ordering groceries, whether it's ordering, supplies, whether it's booking a restaurant. So, I would look at where the long-term trends are going to be coming out of this and look at those accelerations, and there's going to be some opportunities in there. But for sure, over the next 3 or 4 months, I wouldn't make any major wholesale changes. I would just be expecting some volatility. Some may be on the downside, some on the upside, but I think staying invested is going to be the right move long term.
Well, this was awesome, guys. On behalf of all of our clients and everyone on my team, I just want to thank you both for taking time to do this. We know you both are very, very busy individuals. For any of you out there that do have questions or want to do any individual follow-up, please reach out to us and we're happy to provide more clarity. I assume, given the current state of our country, that this probably won't be our last town hall. So we hope you guys are finding some value in these ways for us to connect with you. But again, Chris and Phil, thank you so much for taking the time today. And we hope all of you have a good rest of your day.